It is my absolute pleasure to introduce Rhian-Mari Thomas. And I don't know, how long have we known each other? 8 years? 10 years?
10 years, I
Eight
think,
years,
now,
8
Neil.
years, yeah. So we met when Rhian-Mari was at Barclays and I was doing some work for Barclays. And we've sort of very stayed in touch ever since. Rhian-Mari's been on an amazing journey over that time herself, and has ended up, and I can never get the name quite right, but she's ended up as chief executive of the Green Finance Institute.
Yes.
Which is a body that is funded by both the government and the City of London to transform or to make available funding from the city to green finance stuff, but also to transform the way that finance operates so that it operates in a more sustainable way. But Rhian-Mari tells the story far better than I do, so I shall hand over to her.
Thank you, Neil, and thank you for everyone at Hollis for inviting me to say a few words at your conference. Before I get onto the finance, I always like to start these talks with reference to the science, which I think is critical, that we don't lose sight of. That is what we're trying to do, is integrate science into our financial decision making. So if you'll bear with me, historically, the planet's climate has fluctuated between lengthy glacial periods, during which as much as a third of the planet's surface area has been covered by large ice sheets, and then these far shorter interglacial periods of typically 10,000 to 30,000 years duration, when the climate has been more temperate. And it's during the past 12,000 years, when the Earth has been in one of these interglacial periods, which has been characterized by a relatively stable climate, the Neolithic Revolution started in the Fertile Crescent of today's Middle East, and humans first began farming, and we took these initial steps towards creating our modern society. And then in the intervening period, the stability of the climate has enabled human civilization to flourish, shaping the world in three fundamental ways. Firstly, by maintaining habitable conditions across the whole planet, it allowed humans to migrate right across the world. Secondly, by maintaining local climate stability, it shaped the design of both ecological and human-made systems, such as the choice of which crops to grow where and the engineering design standards used for infrastructure. All these are based on this temperate and precipitation levels from the stable past. And thirdly, by creating a predictable physical environment, it contributed to the emergence of the modern economy. A fundamental requirement of economic and financial activity, particularly over a medium or longer term planning horizon, is this level of confidence that tomorrow will in many aspects be no different to today. And that is what is changing. The average global temperature has increased by more than a degree Celsius since 1880. That rate of warming is 5,000 times faster than the most rapid natural warming episode in the planet's past, and that's based on 65 million years of ice core data. The climate scientists estimate the probability that the natural variability of the climate system could have caused this magnitude of global temperature increase over the past 200 years as a 1 in 35 million chance. So we are now recording average global carbon dioxide concentrations that have not been reached since the Pliocene era. That was over 3.6 million years ago. And this is because we've released nearly 2.5 trillion tons of carbon dioxide into the atmosphere since the beginning of the Industrial Revolution, more than half of which has been emitted in just the past 3 decades. That means we've done as much to alter the stable climatic conditions that have enabled human civilization to thrive since Al Gore published his first book on climate than in all the millennia that came before. Basically, we have now caused as much damage knowingly as we ever did in ignorance. So where do we go from here? I'm going to argue that 3 things are now inevitable. First, inertia built into climatic systems mean there is a lag between record levels of carbon dioxide concentration and the impact on global temperatures. So over the next decade, temperatures will continue to rise. regardless of mitigating actions. And that's going to lead to more severe and or frequent extreme weather events in many parts of the world, according to the climate models. And all of this was set out very starkly in the blockbuster 4,000-page report by the Intergovernmental Panel on Climate Change, the UN's climate science body, that was published a fortnight ago. Climate forecasts may be highly complex, but they are based on the laws of physics, and sadly, they're immutable. And that leads to the second inevitability, that governments will be forced to act more decisively than they have so far. There will be an inevitable policy response. The longer the delay, the more disorderly, disruptive, and abrupt that policy will need to be. And a forceful policy response to climate change within the near term is not priced into today's market. So the UN Principles of Responsible Investing, the UNPRI, has an inevitable policy response unit that aims to predict when and how governments will start to take more vigorous measures and the likely impacts on the real economy. They're analysts, they review key climate policy developments in all major countries with inputs from more than 200 leading experts in national climate policy to develop forecast policy scenarios. And their latest forecasts, which were published in Q4 last year, anticipate that a forceful and accelerated policy response to climate change over the coming years is even more likely than before the pandemic. And they point out that in the run-up to 2025, countries under the Paris Agreement will need to submit their third round of climate pledges following the global stocktake in 2023, which will detail just how far the world is from meeting the Paris goals and act as a crucial forcing mechanism for governments to accelerate policy. And this will all be taking place against a drumbeat of extreme weather events and the resulting pressure from civil society, business, and investors, which will increase around the globe. Most immediate policy and regulatory interventions include bans on coal and on internal combustion engines, a likely increase in nuclear capacity and bioenergy crops, greater requirements on energy efficiency and industrial decarbonisation, including carbon capture and storage, reforestation and bans on deforestation commodities, wider use of carbon pricing, including carbon taxes, and measures to increase the supply of low-cost capital to green economy projects. This transition risk, which is posed by policy or regulatory intervention, is simply one of the ways in which the transformation of our economy could have a dramatic impact on financial markets, companies, and geopolitics over the next decade. But we also have to consider the actual physical risks to business that arise from the increased frequency and severity of climate and weather-related events that damage property, disrupt trade, and the liability risks that stem from parties who have suffered loss from the effects of climate change, who are then seeking compensation from those they hold responsible. And under that banner of liability risk, I believe we're likely to see a rise in litigation risk too. So just this week, Client Earth, a not-for-profit group with a really impressive track record of successfully bringing climate-related cases against corporates and governments, they upped the stakes by notifying Shell's board of directors that is intending to commence legal proceedings against the company's 13 executive and non-executive directors for their failure to adopt a strategy that truly aligns with the aims of the Paris Agreement, claiming that Shell's directors are in breach of their obligations under the UK's Companies Act to act in a way that promotes the company's success. Client Earth wrote to Shell ahead of petitioning the High Court of England and Wales for permission to bring the claim. If it does, this will be the first significant attempt to hold individual executives legally accountable for alleged failures to tackle climate change, and will undoubtedly mark a paradigm shift in how corporate responsibility for climate change is viewed. So all of this, in addition to the most challenging risk of all, the transition risk that could arise through a sudden and disorderly adjustment to a low or zero carbon economy, triggered perhaps by urgent policy responses, but also possibly through rapid advancement in technology or a significant default that could lead to a re-evaluation of asset values and a sudden collapse of asset prices, as we saw in the 2008 financial crash. It's what the economists call a Minsky moment, named after the economist Hyman Minsky. And the only mitigant to a climate Minsky is a transition in thinking and action across every aspect of the economy. It requires pivoting policies, industrial strategy, business planning, so that the impacts of climate change are at the core of day-to-day decision making. And crucially, it requires a profound reallocation of capital and transformation of finance. Because the transition to a net zero carbon economy is a really capital intensive business. It requires rebuilding the asset base which companies have invested in over decades, which on the one hand presents capital providers with a huge investment opportunity, but on the other hand, it poses considerable risk. The introduction of new, unfamiliar, zero carbon technologies to industrial processes that have been honed to maximize efficiency introduces uncertainty and potential near-term competitive disadvantages to first movers. And that poses a challenge to mainstream capital providers. Early stage technology or new disruptive business models, they're typically financed through venture capital, but these funds rarely invest hundreds of millions in a single venture. Pensions and sovereign wealth funds are some of the biggest project and infrastructure investors globally, and they've got more than sufficient capital and ability to invest at scale. Collectively, they represent almost $17 trillion in assets under management. However, they are necessarily conservative in their investment approaches, and they've got really limited appetite for technology risk. And what about green bonds? I'm always asked about green bonds because they've been the poster child of green finance for the past decade. And they raised a record $517 billion in the green bond markets last year. That's the highest annual issuance since market inception and maintains this trend of 10 consecutive years of green market expansion at pace. A prerequisite for a green bond issuer, however, is the ability to generate steady cash flows, which means these aren't the appropriate instruments when cash flows are uncertain, as is typically the case when developing and scaling new technological solutions, or indeed projects where there is a long lead time between the initial capital investment and the generation of predictable and regular cash flows. So it's clear that no single type of financial instrument or institution can meet the investment required. Instead, we need a collaborative effort between all aspects of the financial ecosystem: the venture capitalists, the private equity funds, the banks, the real estate investment, the real asset investment fund managers, investing alongside the public sector and philanthropic capital to deploy primary capital into the real economy at scale. Deploying primary capital, so that's bank lending, bond issuance, equity issuance, IPOs, private equity, venture capital, real asset investment. These are all tools to effect real change. And this is a point I'd really like to emphasize, because so far, in my view, we have focused much of our energy as a finance community on greening finance, addressing climate risk in the financial system. So viewing finance as a means in itself rather than a means to an end. And that's resulted in this focus on aligning portfolios with sometimes questionable metrics, expending precious energy and talent on secondary asset allocation at the expense of a rigorous focus on deploying primary capital towards the real economy challenges. I do want to be clear, the secondary market is a really powerful force for change, but what matters is forceful stewardship over companies' real economy investment decisions, rather than demanding more data and more precise metrics and measurements. This insatiable thirst for data can sometimes, in my view, be quite a troubling substitute for action. And so whilst I agree we do need to improve on some of the metrics and the data, we also need to improve the frameworks for asset managers to hold companies to account, challenging them on what proportion of a company's capital expenditure and R&D spending is actually driving decarbonisation, whether acquisitions are aligned with the goals of the Paris Agreement or to their own net zero commitments, challenging them on what proportion of ensuring that their high emission assets cannot simply be sold off to buyers who will continue their operations but with less scrutiny. All of this needs to be the focus of those that hold equity or shares in these companies. And we're starting to see some of this, but I think, again, a more forceful stewardship is important. And that's really highlighted in the financial sphere, because in the period between the signing of the Paris Agreement at COP21 and the COP26 climate conference in Glasgow, the top 60 global banks lent $3.8 trillion to fossil fuel companies. Bank lending is the single largest source of additional capital for new and expanding fossil fuel prospects and companies. That $3.8 trillion generates a lot of fee revenue. At COP26 in Glasgow, over 450 financial institutions across 45 countries signed up to the Glasgow Financial Alliance on Net Zero, GFANZ, committing to reaching a net zero target by 2050 using science-based guidelines with an interim 2030 target and transparent reporting and accounting requirements. In total, those 450 financial institutions control $130 trillion of global assets. But it seems quite clear to me that none of that money moves unless it makes money, which is why we need radical collaboration between mainstream financial providers, public sector finance, philanthropic capital, in conjunction with policymakers and industry experts, so that we can unlock that wall of capital and deploy it to support climate mitigation and adaptation. What does that really mean? It means governments will need to deploy their financial might as catalytic de-risking capital. So to development finance institutions, the large multilateral development banks and development finance organizations, they have $11.5 trillion balance sheets. And these can in turn catalyze new asset classes and investment opportunities, crowding in private capital rather than financing new assets themselves. So identifying and co-designing the most effective interventions of public impact finance in order to create the conditions for private finance, that really forms the basis of our work at the Green Finance Institute, as Neil mentioned. We focus on co-designing incentives and financial solutions by sector. We particularly focus on the built environment, on decarbonisation of transport, nature positive investment, as well as how we channel more capital into Africa and other emerging markets, so that governments can deploy capital to maximise the crowding in of private sector co-investment. That can be through providing tax credits, loan guarantees, revenue guarantees, contracts for difference, cornerstone investments for green banks or funds, or through creating the demand to drive economies of scale for currently costlier green products through subsidising consumers or directly purchasing through public procurement budgets. All of that is pretty well established thinking, but what is new, what is absolutely unprecedented, are the public commitments that have been made by those financial institutions to get to net zero. And that's translating into this pressing need for them to replace the revenues generated from financing 20th century technologies with the opportunity presented by the electroeconomy of the 21st. In short, they need to find new green revenue opportunities that both meet their required risk-adjusted returns and their net zero commitments, or else they're going to need to pursue a strategy of shrinking to greenness. Quite unlikely and unpalatable. So all of this is going to require a shift in mindset. And Neil and I in particular have previously discussed what that requires of executive leadership teams across both business and financial organisations and those that advise them. Fundamentally, we need more forward-looking leadership that will be capable of overseeing the types of business transformation that will be required to succeed in a marketplace where attention to sustainability challenges will increasingly determine corporate success. It should be evident that the question is no longer whether the transition to net zero will occur, but rather how quickly. Who will lead? Who will be left behind? And these are questions not only of environmental consequence, but of tremendous economic consequence. And that's going to require an understanding of the technologies and the societal behaviours by sector that are rapidly replacing existing systems. An assessment tool that I find particularly instructive in understanding an organisation's positioning on this topic has been developed by Yale University professor Dan Esty, who's a good friend of the Institute. His 4-stage pathway is based on extensive analysis of different businesses' transformation models across various industries and can be used to gauge levels of a corporate's climate integration. So quickly, stage 1 is initial engagement. That's when an organization is focused purely on compliance and risk mitigation. Stage 2, systemic management, that's when an organization starts to develop its reporting, target setting, certifications, and it begins to make some organizational and process developments to align with its targets. Stage 3, transforming the core. That's when sustainability and climate strategy drives product and process innovation, revenue, growth, as well as dictates cost-saving plans. And then stage 4, competitive differentiation. That is when the brand, the business model, the customer and employee engagement, these are all driven by sustainability and climate considerations to achieve competitive advantage and a commercial gain. In financial services, my area of focus, that means embedding the implications of climate change and depleting natural resources into every department of a financial institution. That means not just the relationship managers, but also the credit officers and investor relations and the strategy team, HR, comms, marketing, and also ops, operations, finance, and the treasury functions. And across the financial services industry, we need to see ever greater number of financiers who can marry financial expertise with science and engineering. Increasingly, we also see the need for financiers to familiarize themselves with biodiversity and the risk posed to supply chains and business models from depleting natural resources too. Without doubt, we also need financiers to develop policy expertise. This is both to inform investable policy and to respond to a rapidly changing policy backdrop. I'm constantly hearing of the need for better data, standardized data, decision useful data. And data is, after all, the lifeblood of the markets. But without knowledge, data will only ever just be another set of numbers. So that's why we need financiers who can interpret the data through their understanding of policy, regulation, and science. I also see in my day-to-day role that in order to mobilize capital towards the programs and projects that will pivot our global economy, that we need project management skills, stakeholder management skills, and the ability to lead broad groups of stakeholders, sometimes with really differing agendas and operating styles, towards defined outcomes. But above all, I believe we need financial institutions and businesses that nurture those who think differently. Because setting aside all the complexities and technicalities, I see a really human dimension to the zero carbon transition. Put simply, it's very hard to give up doing transactions and business that you understand for those you don't, and it takes a certain culture to encourage and promote those who are bold enough to have a go doing that. As Neil and Mark describe in their book Stealing from the Future, what got you here won't get you there. So we need leaders who are comfortable dealing with uncertainty and ambiguity. Those who are able to make sound judgments through collaborating and applying knowledge rather than extrapolating from historic trends that aren't really representative of a future that will be disrupted by climate risk and new technologies. So one way to get there is to ensure we have climate literacy all the way from the boardroom to the grad program, so that climate science is fully integrated into everything an organization does. And that's when climate considerations will no longer be given a cursory 10 minutes at the board meeting before everyone gets back to the business of business. Because climate change is the business of business, and it will become a default part of our thinking and our decision making. And that, in my view, is the third inevitability. Thanks so much, Neil. I'll leave it there.
Wow. That is amazing. Thank you so much, Rhian-Mari. And I mean, thank you for that, but also thank you for what you do. And thank you for being as aware and knowledgeable and wise as you are. Appreciated from a whole humanity perspective. Thank you. I'm sure we've got lots of questions. There's a question from Mark here. But I wanted to, the thought that's going through my head as you're saying all of this is that we, Holos, need to have a specific sustainability practice, sustainable leadership practice, whatever you call that, because the bit that, and then you're alluding to it all, but the biggest challenge of leadership generally, I believe, is the challenge of being vulnerable. And most of us were taught from a young age that vulnerability was a stupid thing to do and gets punished quickly. And therefore, most people in most organizations are extremely unwilling to allow themselves to be vulnerable. And as you're saying, people in banks, people in investment jobs, people in pension funds, you're taking that risk to say, well, actually, we're going to do something different. We've no idea what the outcome is going to be, but we're going to do it anyway. That is a really tough gig. And so I'm really interested in how we teach people that's the lower risk strategy.
That's something that I think is incredible. It is crucial within organizations. But if you think about the point that I'm making about radical collaboration between people that are coming at this challenge with very different skill sets. So you need financiers in the room, you need industrialists, you need policymakers, both local and central government. You need the scientists, and you need civil society, all of whom are used to operating in a very different way. Unless you have that vulnerability in those settings. And what I mean by that is the ability to say, actually, your idea is better than mine.
Yeah.
Or, I thought I'd understood this, but you've made me think about it differently. Unless we can create those kinds of safe spaces and collaborative safe spaces where people recognize that that's the way forward, we're not going to make the progress that we want to. And the good news is, and I feel relatively optimistic about this, is the number of people, we've grown the Green Finance Institute during a pandemic to almost 30 permanent staff and another 30 support staff. And thanks so much to all the pro bono lawyers that are giving so much of their time to this agenda. People really want to do something very purposeful. And the types of people that we're managing to Pied Piper out of the city to actually take giant pay cuts and do this work, they're so purpose-led that they are the types that are very willing to sit there and go, I'm here to learn. I haven't worked that closely with policymakers until the last few years, and I regularly have to ask mentors and others to help me to say, I feel a little bit like I'm maybe not navigating this as elegantly as I possibly could, because I'm bringing 20 years of city experience into the room and it's not landing. And so it's creating those types of safe spaces to do that. And I'm increasingly seeing that happen, which is fantastic. I don't know. I've recently got involved. I've recently become a little bit obsessed with the work of Patrick Lencioni. Are you familiar with his work? Yeah, of course you're familiar with his work. And in that 5 dysfunctions of the team, the bottom bit of that foundation of how you make a successful organization focused on results is that you have to build this trust, which he defines as vulnerability.
Yeah, well, I mean, we see our work is so completely reliant on trust. If you're going to trust, we're going to come in and mess with people's heads. So you've got to really trust us to do that. And so that's exactly where we start. And maybe that's part of this point. Anyway, I'm sorry, I'm hogging the conversation. Mark had some questions here, which are, do you feel that climate inaction could reach the point of being open to charges of crimes against humanity? And do you think ecocide will eventually be enshrined in law?
So I'm clearly not a lawyer, but I do speak frequently to those who do work at Climate Earth or the File Foundation or are QCs that are very focused on this topic, because I was really intrigued with the last IPCC report, where they used language saying that it was now unequivocal that climate change was due to the burning of fossil fuels and other very directly named activities. And so I got in touch with the lawyers to ask exactly this question. Once once it becomes more directly attributable, surely that leads to more direct legal action. And we are starting to see that. And you could ask, why hadn't that happened before? But obviously the nature of science is that, it's very difficult to attribute individual extreme weather events that cause loss and damage with specific actions. But that attribution science, as it's called within climate science, that's one of the fastest growing areas of climate science. So I do think over time we will see the more litigation and the legal profession really taking a front seat as one of the key drivers. And that's why I think the Shell motion this week is quite an interesting one. The other point I'd make is I've been doing a fair bit of work on deforestation commodities, or the organisation's been doing some work under the leadership of Sir Ian Cheshire, who I'm sure you'll remember from your time at Barclays, Neil. And one of the things that we're exploring is whether we can start using anti-money laundering rules, which are already well embedded within the financial institutions, to capture illegal deforestation. Because quite often, at the moment, there's very little tracking of how illegal deforestation and monies generated from that, which are completely fungible with legal activities, are actually leading to apparently legitimate fees and revenues in the financial community, and it's a problem.
Let's open things up. Yes, Hamish.
I got a number of comments and challenges, Rhian. Just in that last point on Shell, as you well know, OPEC, I think the OECD oil companies produce, 10% of global oil, and most of it is in OPEC. So beating up on Shell, I don't think fundamentally changes the oil. We have to address demand, not supply, in my view, and how we're going to reduce demand.
Where I disagree with you, Hamish, is when we've seen previous shareholder action, it started off with shareholder resolutions in the oil and gas sphere, and then it moved into the banking area, where it's had a real impact. Notice the work in the UK of Share Action, where they've brought resolutions against both Barclays and HSBC, have been pretty impactful in helping those large organisations start pivoting. So. Whereas I completely agree with you about the dynamics, the supply and demand dynamics in the oil and gas industry, but this is if you like, an entry target that can then, if it works, can then start to be applied to some of the other levers. And so I think it's actually quite an exciting first step.
Now, I suppose, Neil, the question I just wanted to pose to both of you is that you talk as if climate change requires a change in behaviour, but if one creates the right market conditions and commercial incentives, then why can't we get the market to work? For example, the conversations I'm having in the US about using a tax incentive scheme, it's all commercial. There isn't. We're not talking climate change. We're talking what's my rate of return if the carbon price is that. And so it's using, if you like, red-blooded capitalism to solve a climate problem. So that's creating the right market conditions to allow, because I think what you're teaching, Neil, in terms of the authentic leadership, it's independent of climate change. It should affect all business. And so if one creates the right market conditions, then things will move.
And so for me, it's creating those right market conditions requires leadership.
Yeah. Okay. And that means that I think this price for carbon, I think it's fundamentally about how you price carbon.
Well, and that may be one strand of it, but it still requires someone to take a lead on that.
Okay.
I don't think we're disagreeing, Hamish. In fact, I think, until low carbon becomes the default rather than a choice or a sacrifice from a consumer's perspective, we're not going to be able to move fast enough. So it is incumbent on the policymakers and the large corporations to make sure that those choices are cost competitive. But the fundamental premise I had when I was given this huge privilege of running the Green Finance Institute was that the city is full of smart people who are, if they're incentivized correctly, they will find ways of doing transactions that make money all day. Yeah. And yet we've got these huge gaps. We're talking about between 5 and 6 trillion pounds of dollars that are not going to some of the energy reforms that we need to see, particularly in developing and emerging markets. So the question is, what do we do to change the incentives? What do we do to use government balance sheet or concessionary balance sheet or philanthropic capital or anybody that isn't seeking a market return, as you just described, so that we can actually crowd in the money from the markets? Because there's clearly a failure, or the market is stalled in some way. And unfortunately, one of the arguments that I do come across quite often with people who aren't quite there on this journey is that the market should fix this by itself. There's no requirement for regulatory intervention. And unfortunately, if we had all the time in the world, they might be right. But the climate scientists are telling us we've got a decade really in order to bend the trajectory on emissions. And so we can't leave it entirely to the free market. We do need these
and that's
interventions from government.
Your comment about governments being forced to act, I think was really, I was really interested in that. What's bothering me today, as in now, is governments being forced to act, yet you've got the gas prices rocketing and so I'm sensing backing off of UK's climate commitments. And you just note that they're going to accelerate, I saw on the news just now, accelerate oil production in the North Sea and relaxing the climate commitments. So I wonder how we balance the short term and the long term here, where absolutely we got to change. But it sounds like the trouble is governments are short term, aren't they, Rhian? And so long capital requires 20-year returns. I need an income stream for 20 years. And so I'm really, where I'm at today strategically is how do we want governments to act, and I want a long-term commitment. And how do you see that playing out? Because these externalities are going to happen. I'm afraid this isn't the first shock that's going to hit the system, is it?
No, well, we're obviously having this conversation against the absolutely appalling actions in Ukraine at the moment. And we are seeing exactly this short-term strategy of the Prime Minister's out in Saudi and the UAE today, looking at alternative oil, oil supply, which on the one hand you could look at as saying, oh no, this is us really going backwards. And I think Germany are talking about even more coal energy to make up for the gas from Russia. But there is an underlying, if you look at what Kwasi Kwarteng, our business secretary, has been saying consistently for the last few weeks, is yes, we need to get through these, this short-term strategic issue in order to reduce our dependency on Russian oil and gas, which incidentally in the UK is in the single figures. I think, 8% of oil and 5% of our gas. Yeah. So arguably those numbers could be nil, but he keeps saying consistently, this is the best argument ever for us to redouble efforts on wind, solar, hydro, battery, etc. And that unfortunately what we may see is a short-term jumping on the bandwagon of some of this misinformation we're hearing about green tariffs being as much as 25% of our energy bills, which is complete rubbish. It's less than 7%, but this is giving some ammunition to those who are ideologically opposed to a net zero target. And so we're going to, as a community, I think we're going to have to be even smarter about getting our messages out there, that there is no intellectually coherent or robust pathway to prosperity that is based on high carbon. That there wasn't before the pandemic, there wasn't before the invasion of Ukraine, and there certainly isn't now. But we're going to need to make that case in terms of jobs, prosperity, health outcomes, all of this, because I think making the case purely from a moral perspective that this is the right thing to do for future generations, unfortunately may fall on deaf ears of some of the people that we need to convince.
High prices for fossil fuels are not a bad thing. And if you were to price in climate change into fossil fuels, that would be even better.
Well, I think if the oil price is over $100 a barrel, if you sequester that carbon dioxide, it's about $30 on a barrel of oil. So, and it seems like our economies can carry that and capture the carbon dioxide. So It feels like the demand is inelastic, actually. So
the issue about the high fuel prices, though, however, from an investor's perspective, is that there is an opportunity to make short-term profits.
Yeah,
absolutely.
It encourages more investment in oil.
Yeah, in the last few years, we've seen these huge influx of net inflows of capital into ESG, environmentally, social and governance aligned funds. I think at one point it was up to about even a third of total assets under management, if not even a bit more, on the sort of broadest definitions. And there was a lot of compelling statistics showing that those types of funds were outperforming the market. And I was always really nervous about talking about it in those terms, because I was like, well, what happens if and when those funds are underperforming the market, because we do see a spike in oil prices, or we do see an opportunity for short-term profit making? Will people take their money out? As opposed to recognizing that, that there is very little point investing in a pension if what you're investing is an uninhabitable future. You need to make sure that you're investing in line with not only your values, but in terms with a future that actually, where capital is going to the real economy challenges, that means that we'll be able to enjoy the fruits of saving, those of us who are lucky enough to do that. So it's a far more nuanced argument than I think unfortunately gets played out quite often. But where I am optimistic is that there are more and more people who are engaging in this discussion. In a way, it is becoming a mainstream discussion in financial services, and that's a source of real optimism.
What about the continuing subsidy of the fossil fuel industry in the UK and other places? I mean, what's that about?
Do you know, that comes as a real shock to people when you tell people that.
It is a shock.
Yeah, even financially sophisticated people, when they trot out the lines about, oh yes, but don't renewables require huge amounts of subsidy? And I say, but the largest areas that we subsidize is fossil fuels. And you send them the statistics and they're nearly always very shocked by it. Yeah, that's an obvious area for reform, an obvious area. And the point that Hamish was making about carbon taxes or carbon pricing, whatever you want to call it, but actually properly pricing the externalities and the cost into production.
Yeah. And on a global basis, Rhian, because what I can't help but note is that we've got an emissions trading tax in the UK, and in the US it's a tax credit system. So you'll get government money, you get an income in the US and a tax in the UK. So there's a real difference in how this works, which is unsustainable.
The topic of border carbon adjustments is one of the big stalling points, as you well know, on this whole discussion. But again, I think that as we start seeing the impact of unfortunately, as the climate models become an ever grimmer reality, some of these discussions, we were smart enough to get ourselves into this pickle. We are smart enough to figure out how we get out of it, is definitely my view. And a lot of this is to do, it's got to do with political will, and a lot of these things are fairly unpalatable. And we obviously do need to make sure that some of these reforms don't end up penalizing the most disadvantaged in our communities or in the global community. But none of this is beyond the wit of smart people who are willing to radically collaborate to make things work.
And governments are brave enough to put policy in that create the market, I think.
And that's where we come full circle with the point that Neil is making about all this requires bold leadership, a certain different way of thinking and leading, because there is no playbook. The world's never been through a net zero transition previously, and so we do need people who are courageous enough to make decisions based on first principles thinking.
Yeah.
So just to put an extreme case, but not a unique case, we've done quite a lot of work in Kuwait for Kuwait Petroleum Corporation. We currently work for the retail end of that business in Northwest Europe and Southwest Europe. So that's Kuwait, the brand, if you remember them. The retail brand in Northwest Europe have committed to every customer journey being sustainable as their vision, because in alignment with the Dutch government's commitment to banning the sale of combustion engine vehicles by 2030. But of course, they're very much at odds with their single investor in having that vision. KPC as a company provides, I'm going to get these figures slightly wrong, but it provides something like 60% of external revenue to the country of Kuwait, and 90% of 90%, so 60% of GDP and 90% of external revenue to the country of Kuwait, country of 5 million people. That is a problem in this transition. That level of dependency on an entirely toxic business model. How and failing to address that is not a sustainable policy either. I know that the Kuwaitis, to some extent, and the Saudis to a greater extent, and some other countries are looking to invest in better ways, invest in renewables, and have sovereign wealth funds that provide, and all of this sort of thing. But those countries have one of the things that those countries have failed to do is adequately educate their populations, because they didn't need to effectively. So whilst there are clever and wise people there are an awful lot of people who are neither clever nor wise. What do we do? How do we help that situation?
So if that's directed at me,
yes, you're the clever.
I'm going to well, as opposed to Hamish. I think what we need to be really careful about a discussion in some countries where they need to go through a radical change in their industrial strategy is that this can't be another colonialist Western imposition. This needs to be driven very much in country with, and from a financial perspective, just obviously less valid in some of the big petro states. But if we look at somewhere like South Africa, where it's huge reliance on coal and a very, very high carbon intensive economy, we can't just find ways of channeling more capital into these types of jurisdictions unless we make sure that the policy environment and that there is to Hamish's earlier point, a longer term commitment to some of the reforms that we need to see. As financiers, this is where I'm very happy to learn from others, but very reluctant to opine on other people's areas of expertise. The work that we've been doing and that my team have been doing in South Africa and some other African countries has been on how do we set up the right financial mechanisms, assuming that other smart people are going to work on that whole backdrop and enabling policy, so that we're actually channeling capital in the most effective ways, using guarantees, not grants, wherever you can, because there are very compelling commercial opportunities and business cases that can appeal to mainstream financial institutions who have this net zero target, but those situations need to be de-risked. And at the moment, that isn't happening as efficiently as it could, using the multilateral development bank community, using government balance sheet. There is a lot of interest, but it isn't turning into the execution that we need to see. So we are having some really interesting conversations with government officials in those countries, as well as government officials in the UK and the US, around how we can bring financial expertise and more sophisticated types of structures into this discussion, so that we're crowding in private finance and the money is going further. When it comes to countries like Saudi or Kuwait, I agree, we're seeing some green shoots, but it's it isn't so much to do with smart or not smart people. It's just to do with how so many systems are set up to defend themselves, defend the status quo. And I would say figuring out how you change the status quo, Neil, is far more your wheelhouse.
Well, I mean, the challenge is, I don't think the challenge is colonialism. The challenge is demand reduction. And you know, where I mean, obviously, Putin's actions have changed that equation, probably briefly, but you know, the risk is that we just take away demand from those countries, and there's no replacement economy to backfill that, and you know, those systems that you talk about are so addicted to their existing model that they don't have the flexibility to adapt to over a short period of time, to adapt to a different model. And then, you know, the other side of that is that those countries are broadly uninhabitable by the scale of population that they've got, because they cannot grow enough food because they don't have enough water. So you know, population of Saudi is something like 35 million. The geography of the country without oil can support maybe 3.5 million. That's
I think where I'm at, Neil, is that every oil company, every oil producer, I think, should get to a place where for every barrel of oil you put into the ground, put out, you've got to take a third a ton. Three barrels of oil is a ton of carbon dioxide. For every 3 barrels you put in, you've got to take a ton out. And I just feel if you're looking at the size of Kuwait's sovereign wealth fund, if they started thinking in those sorts of terms, with the commercial structures that hopefully Rhian can help put in place, then there's no reason why that shouldn't happen. And indeed, when you've got an economy like South Africa and India, or even Poland, which is coal is so endemic, I cannot see them getting off coal without taking the carbon dioxide away from coal and sticking it underground. Because I think it's so woven in, and that in the Middle East, the fossil fuel economy is so endemic in society. But
the positive thing about coal is that your solution works.
Indeed, yeah.
The trouble with oil is that a great majority of it is burnt in places where it's very difficult to stick it underground.
That's right, in a car.
Yeah, exactly. You know, I think even you, Hamish, would be challenged by taking tailpipe emissions and sticking them directly underground.
Yeah.
But Neil, I think your point's a very valid one, and that's why it's been encouraging to see all the discussion in the UK recently starting to focus on energy efficiency again. So that you know, it's not just, I mean, obviously at the GFI we focus a lot on energy efficiency of homes. That's one of our big flagship projects. But it's energy and efficiency within industrial strategy and within industrial operations, and that is something that, you know, again, it's a challenge to the engineers, but it is a challenge to the financiers too.
Well, and if you make the fuel more expensive, I mean, this is the other thing, isn't it? That people talk about market forces as if they're fair, as if there's a level playing field. You know, that's a policy decision. It's not an economic decision, or it's not a law of physics, is it? So you can make oil and coal and all of these things more expensive, and you can make wind and solar cheaper.
You could make it fair by, Neil. I mean, there's no reason, you know, we got tax-free allowance where we don't pay tax. There's no reason why one shouldn't have that in energy. I think, because I think energy is a right, and I think should be free. There's a certain amount of energy should be essentially free to people, and then you pay through the nose if you use more than that, or carbon or something. I don't know, but there are ways of making it fair.
Yeah, and if businesses pay higher prices because they're using more of it, then they will figure out ways to be more efficient very quickly.
The way Hamish just described exactly that idea of a cap, and you know, above that you get penalized. That's exactly how some carbon taxes have been structured, because obviously a carbon tax needs to it needs to encourage innovation, as opposed to depleting the profit and loss of organizations that could otherwise be invested in capital expenditure and research and development that we need them to invest in for the net zero transition. But I'm pleased to say we've been working with the Zero Carbon Commission on this for a while, and there are some publications on the GFI website on exactly this topic. If any of your viewers would like to take a look at that, Neil.
Rhian-Mari, I'm conscious that it's 10 o'clock and that you have a world to save, so I don't want to take up any more of your time here. But just hugely grateful for your session today and your time today and everything that you're doing. Thank you so much. This is recorded and it will be available on Swapcard for everyone else to look at later on. I thought your opening words were just incredibly powerful and so insightful. Thank you very much. And
thank you very much, Neil, and to everyone on the call. We're all doing our bit. So and it was great to spend time chatting with you and Hamish. And
you may well hear from me. I may be calling on. I may be pulling together a group of people to think about what a sustainable leadership offering would look like. So I'd love to have your involvement in that.
Perfect. All right.
All right. Thanks so much, Rhian-Mari.
And all the best for the rest of your conference.
Thank you so much. Thank you. See you soon.